Do you have a child who's going to be attending college in the 2024 to 2025 school year? If so, this video is probably for you. You may already be familiar with the free application for federal student aid, otherwise known as the FAFSA. Today, we're going to talk through some of the FAFSA changes that have taken place due to a recent legislation called the FAFSA Simplification Act. In this video, we're going to discuss the changes that have now taken place due to the FAFSA Simplification Act. In particular, we're going to talk through some of the procedural changes, some of the timeline changes that have now taken place, and in separate videos, we're going to cover the good and the bad for most middle-class families. What's happening, everybody? I'm Danny Sinowitz, the College Dude. Pretty simply put, the FAFSA is the starting point for any type of application for federal student aid. It's different than a college application in that you need to apply to each college that you would like to go to, or technical school, or any type of school that is post-secondary. However, the FAFSA is a starting point to see if you're eligible for and able to get any type of federal student loans. The FAFSA previously consisted of 108 questions that would need to be completed by both the parent and the student in the event that the child is considered a dependent student. If the child is an independent student, which means that they may have criteria such as they are over the age of 24, they're married, they have a dependent, among some other factors. If that's the case, they did not need to include any type of parent financial information, whether that be income or assets. But for most college-bound children who graduate high school and are planning to go to college, their parents' information would need to be included. Specifically, it's the parental income and parental assets, in addition to student income and student assets. That's not really changing. That's going to be staying the same. However, the questions that are going to be asked are going to be changed. There aren't going to be nearly as many questions on the new FAFSA. There's going to be around 46 questions, not all of those which need to be answered depending on how some of those previous answers are answered. So it's going to be a more streamlined process as we get towards the new FAFSA, thanks to the FAFSA Simplification Act. Let's talk through the assets that are included on the free application for federal student aid. So the first thing that we want to cover is the fact that the assets in a parent's name are assessed at 5.64%. Any assets that are in a student name are assessed at 20%. What's important to understand is that these assets are going to be included when coming up with your student aid index. So when we look at the assets that are included, the first one that's very common are going to be bank accounts. And these include things such as your checking account, savings account, any money markets or CDs. They're also going to include cash that would not be held inside of a bank. So in other words, cash that you have on hand. New to the FAFSA is going to be the net worth of a business of under 100 employees. So any businesses that had over 100 employees, they previously included that, but they're now going to be included family farms and businesses under 100 employees and the valuation of them when completing the FAFSA. They're also going to have investment real estate, which is really taken from the value of the real estate minus any liabilities. And then they're also going to include things like 529 plans, Coverdell accounts, or prepaid 529 plans. So college savings accounts are included as a parent asset. The UGMA and UTMA accounts, which stands for Uniform Gift to Minors Act or Uniform Transfer to Minors Act, is also a way that people have saved for their children. They're also known as custodial accounts. These accounts are technically property of the student, not of the parent. So you do need to include them as property of the student, not of the parent. It's a student asset that's included on the FAFSA. They are also going to include brokerage accounts, which are commonly referred to as taxable accounts or non-qualified accounts, but be sure not to include any non-qualified annuities. They're also going to include individual securities which are not held inside a retirement account. And lastly, something new to the FAFSA Simplification Act has resolved is that child support is now going to be considered an asset, not income. And why that's a favorable thing for most families is that income is usually assessed at a higher rate, at a minimum of around 22%, as opposed to the asset which would be held at 5.64%. Now let's talk through some common assets which are not included on the FAFSA. Now, to be clear, these assets may be included on that CSS profile we talked about before, but at least for the FAFSA's sake, these are not going to be included. The first one is a family's primary residence. So any home equity that you may have in the primary residence, you do not need to include in the FAFSA. The second is any life insurance cash value that you may have inside of a life insurance plan. The third would be an ABLE account, which are typically held by folks who have a disability. And the reason that they would hold those is it does allow them to achieve some level of holding on to assets, but doing so in a way that allows them to qualify for government benefits. Any annuities that are held do not need to be included. As we mentioned, if they're a non-qualified annuity, you don't need to include that inside the FAFSA as an asset. Two other ones that often get asked about. The first one is retirement plans. You don't need to include those. Those can include traditional IRAs, Roth IRAs, 401k plans, any pension funds, any type of simple IRAs or SEP IRAs as well. So those you don't need to include when completing the free application for federal student aid. Lastly, one that gets brought up a lot are grandparent-owned 529s or 529 plans owned for the child's benefit but not owned by the parents. This is an example of something that you do not need to include on the FAFSA. Technically speaking, the grandparents are the owners of these plans, and the child may be the beneficiary. Therefore, it's grandparent-owned, and since the child's a beneficiary, you don't need to include it on the free application for federal student aid. In terms of the timeline of when you would complete the FAFSA, previously it was October 1 of the year prior to you enrolling in school. So for example, if you were going to be enrolling in the 2023 to 2024 school year, you would have completed the FAFSA on October 1 of 2022. So in this circumstance, with the upcoming change that has taken place, the FAFSA deadline, or I should say the FAFSA opening, is going to be pushed back to sometime in December. They're targeting a December 1 date, but it doesn't necessarily mean that that's the date that we're going to have. There's probably going to be sometime in December that this new FAFSA is going to be unleashed. Now, moving forward, the target is going to be October 1 to get us back to that normal cadence that we have been in. However, this is going to be a one-time delay due to the new act that has taken place. The tax return that you would have used is 2 years prior to the year in which you're going to enroll. So in that previous example, for an October 1, 2022 completion, you would have used the 2021 tax return. So the tax return is always filed prior, and that will continue to be the case. With the change in the FAFSA this year, it's going to affect everybody who's applying. So even if you've previously filed the FAFSA prior to the passage or the implementation of the FAFSA Simplification Act, you are going to be affected moving forward, regardless if you filled it out the old way or the new way. So no one is going to be grandfathered in to the old way. Moving forward, any of the changes that take place are going to affect every applicant. So one of the things that we want to be sure of is you're probably used to some old terminology and some new ones that are going to now be taking its place. The previous terminology that you may be familiar with is the expected family contribution, otherwise known as the EFC. The EFC was a measure of a family's financial strength and would usually be a starting point to define how much it is that you would need to pay to go for college. The EFC is now going to be a retired term, and it's going to be replaced with what's known as the Student Aid Index, or the SAI. The Student Aid Index is going to be very similar in terms of what it would do for the expected family contribution. However, it's a little bit more realistic in that the expected family contribution was just a starting point. Many colleges would use that number and they would come up with their own financial aid package, which could be a lot different than the number that the Department of Education would give to you. So therefore, the Student Aid Index is going to be a bit more accurate in terms of an actual terminology usage when it comes to paying for college. Your Student Aid Index will not necessarily equal the net cost from one college to another in which you're expected to pay, but it is a good starting point. 3 big changes right off the bat that you may be familiar with in the old way, which will no longer be applicable to the new way. Number 1 is if you have a drug conviction, it won't preclude you from actually completing the free application for federal student aid. Previously, that question was asked and could affect your ability to fill out the FAFSA. Moving forward, that's no longer going to be the case. The second change that's going to take place is for young men, 18 or older, you no longer need to complete the selective service application. So prior to completing the FAFSA, you would have to enroll into the selective service in the event the U.S. military would institute a draft. That's no longer the case, so the selective service question is going to be eliminated on the new FAFSA moving forward. Thirdly, you can now send your student aid index after you complete the FAFSA to up to 20 schools, where previously you were only able to send it to 10 schools. This does just expand the ability to send your financial information to different schools in which you may be applying to. There are some procedural things you can do if you have more than 20 schools on your list. But if you have more than 20 schools on your list, you may want to get a little bit more condensed in your college search. That colleges can no longer have a policy in which they deny all financial aid appeals. Instead, they need to have a case-by-case basis in which they go by when considering a financial aid appeal. Specifically, those special circumstances are going to include just a couple of things. The first one could be an unusual business in which the parent could be involved. In other words, there could be fluctuating income from year to year due to an uncertain or an unusual business in which that parent is involved in. Two other common things that you could be noticing in terms of the case-by-case financial appeal basis is the first one being investment or real estate losses. On a tax return, you could notice some differences from year to year, specifically in investment returns or in real estate losses. Since those numbers can fluctuate from year to year, colleges will need to consider this on a case-by-case basis. But again, no college can have a policy in which they say we're disregarding all appeals. The other circumstance that can be brought up is if there's severe disability from a student, a parent, or a spouse in the event that they're applying to college. And a college should take that into consideration within a financial aid package. Currently, there is a financial aid appeals process in which parents and students can appeal the financial aid package that they receive. But this is just going to blanket statement the idea that a college cannot have a process in which they deny all appeals. One of the other big changes that are now taking place is that the U.S. Department of Education is able to better regulate the cost of attendance in which schools offer. So the cost of attendance is that sticker price number that colleges put on their website. It includes everything from tuition and fees, room and board, transportation, books, supplies, equipment, pretty much everything that can be included in the cost that it would require a student to go to that school. Rarely, if ever, does a student have to pay that cost of attendance, that sticker price, which they'll see on there. Usually there's some sort of financial aid that they're able to receive, whether from the federal government, the state government, scholarships from the school, scholarships from an outside source, whatever the case may be. There's usually some level of financial aid that is included in that. However, the U.S. Department of Education is trying to get a little bit more strict in how they regulate the cost of attendance per school. One of the changes that they're going to be noticing now is that there's no longer going to be what's called a room and board fee. It's now going to include meals and housing. Oftentimes, schools would break it out where room and board and meals would be separate. However, meals and housing are now going to be combined into one fee. One of the other changes within the meal plans that are usually required by colleges is that the previous allowance was based on 2 meals per day. Moving forward, it's going to be based now on 3 meals per day. Therefore, the meals allowance is going to change slightly. Another change that you're going to notice is that if the student is living at home, colleges cannot set that allowance to 0. They need to take into account students that are living at home into their actual cost of attendance plan. Another change that can get lost sometimes, or many people aren't aware of, is that there are actual loan fees for the federal loans in which are taken out. For the loans that are included in the student's name only, otherwise known as the direct loans, the direct unsubsidized or subsidized loans, or the direct Stafford loans, there is a loan origination fee of a little over 1% on every single loan that's taken out. Moving forward, that's going to be a little bit more transparent on the actual cost of attendance application which the student's going to be taking. There's another definition change in terms of the transportation costs, or the transportation cost allowance, in which schools must be required to. Previously, transportation cost in the total cost of attendance included the transportation between home and school. It's now going to be including work, home, and school. The other thing that you'll notice when it comes to transportation costs is colleges may need to include the cost of conferences or special trips, which would be required for a student to take. This is something that's more procedural in nature, but it will be a change that you're going to notice on the actual cost of attendance. Lastly, there is the elimination of a paid preparer for the free application for federal student aid. The Department of Education is cracking down on people who market their services to say that they're going to charge to help a family fill out the free application for federal student aid. While some people may do that as part of a larger service, you cannot be charging directly to help families fill out that free application for federal student aid. The process is now going to be streamlined and should be much easier for parents to complete, even though they may still have questions. If you still have questions though, there are plenty of free resources in which you can utilize to help complete the free application for federal student aid. There really is no reason that you should have to pay somebody to complete this. It can be done on a free basis, and you can reach out to professionals who are willing to help you at no charge. There is still going to be a difference with what's known as the CSS profile, however. The CSS profile is required by about 400 or so schools, and you'll see shortly what those schools are. But they use a different terminology when it comes to determining your expected family contribution, or otherwise known as your student aid index. The changes that have taken place with the FAFSA have not necessarily translated over to the CSS profile. We'll see if this does change moving forward, or if schools that were previously just using the FAFSA are now going to use the CSS profile. However, this change itself is important to understand because depending on which school you're applying to, they may either use just the FAFSA or they could be using the FAFSA and the CSS profile. If they're using both forms, a lot of the changes that have now taken place with the free application for federal student aid are either going to be wiped out or aren't going to be totally considered if you're also going to be using the the CSS profile in addition to the free application for federal student aid. So what parents need to be aware of is the type of schools in which they're applying to. Let's take a look at a couple examples and some ways in which you can find out if the schools that you're applying to just use the FAFSA or if they use the FAFSA and the CSS profile. So let's find out if your college requires a CSS profile or just the FAFSA. The way that we can do that is going by a free website called collegedata.com. Let's go through two examples. So the first one that we're going to look for is a school, University of Pennsylvania. So I type that in here and it should pre-populate as I'm going through. I find it down here and I click, and once it pops up, I can then see and gather some initial information right here. What you can then do is you can go to the Financials tab right here. Once you click, you're going to then see the cost of attendance and some of the details below. When you look at the applying for financial aid, you'll see some of the information here. But the further you scroll down, you're going to see this methodology for awarding institutional aid. If you see both federal and institutional methodologies, you're going to know that it's going to require that CSS financial aid profile. If you're unsure whether or not your school has the CSS profile, that's usually the best place to start. One other thing that you can make sure that you're looking for if it only requires the FAFSA is just by, again, searching in here. So let's look for a school that would likely not require the FAFSA. You can type in a school such as, if we're looking local to Pennsylvania, Millersville University. So I type that into here, and I see Millersville University is listed down here. And the further that I get down to here, I can again click on the financials page, and I'll see on here that it just shows the federal methodology for awarding institutional aid. I know that if I see federal methodology, it's just going to be the FAFSA that I need to complete, not the CSS profile. I hope you found this insightful. The changes that are upcoming are going to be pretty significant. So you want to make sure that whether you've been in school or you have a child in school who's completed the FAFSA for the past few years, that you're aware of the changes that are upcoming. The other thing that you need to keep in mind is that if your child is a first-time college student, these changes are going to take effect this year and are going to be the new normal moving forward. So you want to make sure you understand how this works. You may have been planning a certain way, but that way is now going to change. The other thing that we need to keep in mind is that there are going to be some positives with this change and some negatives with this change. Make sure that you like this channel, share it, and subscribe so that you're able to see some additional changes that will be taking place, specifically the good that come with this and the bad that come with this, and what type of families are going to be affected.